Hey, everybody. Thanks for joining us today for the webinar. We're going to focus today on tax credits and incentives, specifically around R&D, bonus depreciation, and energy tax incentives. This is part of our overall tax horizons planning ahead after the reconciliation bill. And my name is Marty Kerman. I'm a partner for Cherry Bekaert. And in this CPA webinar, our team's going to focus on expanded opportunities and compliance updates surrounding R&D, bonus depreciation, and some key energy-related provisions. I'm proud today to introduce our speakers. We're going to begin with Casey Pittman, a managing director. Then we're going to move to Vivian Kors and Carolyn Driscoll. They're going to talk about R&D. Glenn Lemieux is then going to talk today about bonus and cost segs. And Dave Mohammed is going to talk about the IRA and the energy incentives. So with that, we're going to move ahead. And Casey, why don't you take it away?
Yeah, thank you so much for having me. If we can just go to the next slide. I just want to give some overall context about this bill as we go into some of these discussions. This bill was primarily a tax reform bill. It was largely driven, the timing was largely driven by the fact that there were numerous Tax Cuts and Jobs Act provisions that were set to expire at the end of this calendar year if they weren't renewed. So that is what made this all happen in 2025. It happened in the middle of the year because Republicans really made a bold push. They tied the federal debt limit increase to it and got it done, thankfully, in terms of us, being able to help you plan and strategize here in the summer versus, Tax Cuts and Jobs Act, which came at the very end of the year. So here we are, we have some retroactive provisions and we have some prospective provisions, and we are here all to work together to help you guys plan to take advantage of those taxpayer favorable provisions and to really mitigate the impact of those unfavorable provisions. It's important to note this bill was passed with only Republican support. Not all Republicans, but the vast majority of Republicans voted for this bill, no Democrats. And that's not uncommon. Over the last 20 years, both Republicans and Democrats have had tax reform bills where they used the reconciliation process and had no participation from the minority party. But we say this because there are some permanent tax provisions in this bill, but permanent just means not expiring. These provisions are certainly subject to change if and when there is a change in power in Washington, or a change in circumstances for the United States, our fiscal trajectory. They can obviously change, move to the right, move to the left. So while they're permanent, that only means that they don't expire. They are certainly subject to future legislation. However, most of what we're going to talk about today has a lot of bipartisan support. So we talk about the Section 174, the ability to deduct research and experimental expenditures in the year in which they're incurred, rather than capitalizing them and deducting them over a period of 5 years. That was something that received overwhelming bipartisan support in 2024. And then we talk about bonus depreciation. Again, the ability to write off those qualifying assets in the year in which they are placed in service rather than depreciating them over their useful life. Another provision that had a ton of bipartisan support in proposals in 2024. So those are not particularly, I don't see them at least as particularly at risk in the future. The place where there is some tension is these IRA credits. Inflation Reduction Act was one of those bills I talked about that was solely a Democratic reconciliation bill. It passed in 2022, and a lot of those priorities are Democratic priorities. Republicans found it difficult to claw back all of the ones that, some of the more conservative members were looking to claw back, because they have had a positive impact in states that are primarily Republican or districts that are primarily Republican. So it's a little bit more of a targeted clawback rather than an overwhelming clawback. But those are, that's an area where Democrats and Republicans are sort of at odds. So just wanted to set that stage before we go into these discussions. This is a huge bill. Tax Cuts and Jobs Act was projected to, the tax provisions were projected to increase the federal deficit by $1.5 trillion when it was passed in 2017. The One Big Beautiful Bill is projected to, the tax portion is projected to increase deficits by $4.5 trillion. Now, there are some tax savings. This was primarily a tax bill, but there were other savings, particularly related to Medicaid spending and SNAP, which is sort of food stamp spending, that provided some savings, over $1 trillion of savings, around 1.5 trillion. So that number does get clawed back by provisions in other areas, but just the breadth of provisions provided for in terms of cost in this tax bill. And that should relate to, again, opportunities for you to take advantage of, or again, those negative, unfavorable provisions for us to help you mitigate the impact of those. So that's our larger context. And I am going to kick it back to Marty so our experts can take it away.
We're going to hear first from Vivian and Carolyn, but we are Tax Credits Incentives Advisory. That's the name of our group. And we are really focused on companies and organizations that invest in R&D, maybe purchase or refurb commercial real estate, or invest in energy efficiency, or want to lower their tax liability by purchasing tax credits. Additionally, we're pretty focused on the Inflation Reduction Act, and we have been since it came out in 2022. We're also focused on state credits and incentives. The first four of these are things we're going to talk about and that the bill had something to do with, without a doubt. We're going to talk about R&D a lot here at the beginning with Vivian and Carolyn, as I said, and then we're going to talk a little bit about some new reporting requirements in 2025 that are coming out that need to be adhered to on the Form 6765. With that said, let's move to the next slide, and I'll give it to my team.
Thank you. Thank you, Marty. Thank you, Casey. Hi, I'm Carolyn Driscoll. I'm a director in our TCIA group, sitting out of Southern California. I focus on R&D, as well as tax controversy around R&D, and I head our QC. So thanks for joining us today. Going to give you a really quick overview of the four-part test and the R&D tax credit. I think most people on here understand this, and I want to make sure we get to handle all of the bill changes. So 4 parts, right? 4-part test, need to meet all 4 parts. Business component, permitted purpose. Business component is something that I think I've been doing this for 20 plus years. We used to have that be synonymous with project, but I really think the term business component is key because it suggests that what they're doing isn't just scientific discovery, but a practical application within a commercial context. I think that's important. So what are you trying to do? Improve a new or improved product or process or design, function, performance, reliability. Is it more efficient? Is it, reducing failures or unexpected errors or downtime, or quality as well, right? Higher durability, better materials, fewer defects. Next is technological in nature, and it has to rely on the hard sciences as opposed to the soft or social sciences. Elimination of uncertainty is really important. This is the 174 aspect of it, which Vivian's going to get in. And again, this is measured at the outset. I was talking to an engineer at a construction company yesterday, and he's like, our whole engineering process is intended to eliminate the uncertainty and risk. So it's really critical that it is measured at the outset of the project when you're starting. And uncertainty around capability or method or appropriateness of design. Process of experimentation, 4th prong, and that is undertaken to resolve the technical uncertainty that's identified. And that's an iterative process. So, all right. What are qualified research expenditures? There's 4 categories. It shows through here. So box 1 W-2 wages, and it's pretty expansive. And that is for people whose activities meet the 4-part test that we just discussed, 1 level up, so direct supervision, and 1 level down, direct support. So it really can be expansive. Supplies, prototypes, supplies that are used or consumed, first run production, extraordinary utilities. I've never done that in my 20 plus years. And then contract research. So the contract research needs to also meet the 4-part test. And that is at a statutory reduced amount of 65%. The 4th prong is computer rental, and that is from 1984 when this started. Now it's cloud hosting costs for sandboxing or dev environments. So we've got one of our information requests here at Cherry Bekaert. We ask for this information and perform a complementary scope because it's important to not only identify how much credit you get. But as we dig into this a little further, how you're going to treat it, are you going to elect the full credit, the reduced credit, and can you utilize it based on your tax situation or your entity structure? All right, next slide. There's two different ways to calculate the federal credit. There's also 37 states that have state credits that you're able to avail yourself of both. The state credit if the activity is performed in the state, and the federal. So it can be pretty lucrative and a nice tax planning opportunity. Alternative simplified credit is a 14% credit, but it's more simplified because the base amount, it is a credit for increasing research activities. So the base amount is the prior 3 years of QREs, where the traditional method is a 20% credit, but the base amount is more complicated.
And so
Right,
let me
next
add
slide.
here in
Oh.
the next slide. Oh, yeah, let me add something here. So since 2022, we've had to capitalize our, go to the next slide, sorry.
Yep.
We've had to capitalize R&D expenses. So this happened back in 22. It was passed in law in 17. We spent a lot of time working with companies to minimize their capitalization as best we could while maximizing their credits. Vivian's going to talk a lot about how those rules have changed. It's a massive opportunity for companies that maybe didn't claim enough in 22 through 24, or that have capitalization sitting on their books and can utilize that from a planning perspective into 25 and 26, or maybe back in 22 through 24. It's not extremely nuanced, but there are a lot of choices that you have at your disposal, depending how big of a company you are, how large your credits are, and how much capitalization you have, and what your overall tax position is. So we're going to get into that now. It's the R&D stuff is the biggest thing that we do in TCIA, and we have more resources dedicated toward that than anything else. And we're going to be here should you have any questions after this, but Vivian, take it away and talk about all those opportunities.
Thank you, Marty. Well, nice to meet everybody. My name is Vivian. I am a tax partner, and like Marty said, I focus on all things R&D. And when I started my career, I was always a good guy coming in and saving everybody tax dollars by helping them claim an R&D credit. And as Marty said, starting in 2022, that was my villain era where I started telling taxpayers, unfortunately, they had to capitalize and amortize their domestic R&D spend over 5 years, and then their foreign R&D spend over 15 years. And as you can imagine, that was quite a hit to certain taxpayers' taxable income. They weren't expecting that. And a lot of times they had to pay more cash taxes out sooner rather than later. And although it is a timing difference, it is real cash that's going out the door. So it was definitely hard to kind of communicate that to taxpayers, and definitely harder on the taxpayers themselves. So what this is, and if you've worked with us before, is kind of 174 costs that are research and experimental in nature and incidental to all research and experimentation. And this table that you kind of see in front of you is all the different types of costs, obviously not all inclusive, depends on their facts and circumstances, but generally what we would see that would be applicable to Section 174 costs. We showcase kind of what the difference is between Section 41, which is that little smaller bubble, and within that smaller bubble is the bigger bubble, which is the Section 174 cost. So it's definitely more encompassing. And again, Section 41 is U.S. cost only. Section 174 is foreign and U.S. cost. So with that said, before we jump to the changes, I believe we have our first polling question. So polling question number 1. Did you capitalize research and experimentation costs in 2022 to 2024 for tax purposes? Yes, no, maybe so. I'm hoping yes, because now we can help you.
Yeah, and if you had them, you were clearly supposed to, but if you didn't, there's still ways to cure that and address it through accounting method changes that we can address right now in 2024. And so now is the time to make sure like you're addressing all that stuff and taking a hard look at it. So I think it's a great time. Thanks, Vivian. We're gonna keep going on with you. Anyway.
And I'm probably give it 30 more seconds for polling questions. I know CP is extremely important to everybody here, so I want to make sure everybody has the chance to get their answers in. But if you haven't,
I'm kind of manning the looking at the webinar chat, see if anybody has any questions. So feel free. I'll keep an eye on it and I'll bring them up during the during the presentation and like interrupt Vivian just like I did. So anyway.
So some yes, some no. More of the no's. And that's perfectly fine. Let's see how we can help you. So with the Big Beautiful Bill comes the change with the new section 174A. So this relates to domestic research and experimentation costs. Again, this is all costs that are incidental to R&D, but this is for domestic only. Taxpayers now have the ability to go back to timely expensing their domestic research and experimentation costs starting in the tax years beginning after December 31st, 2024. So basically your 2025 tax year. And again, I want to highlight this is only for domestic costs. Taxpayers are no longer required to capitalize and amortize, and they still have the option to amortize if they wanted to for 5 years or 10 years. But the beautiful thing about it is now you can fully expense and reduce your tax liability in the year that your costs are incurred. What is a slight downside to this is taxpayers would now have to make the 280C election to take the reduced credit, or they have to reduce their 174A deduction by the amount of the R&D tax credit. So effectively, they get 21% less of their R&D credit, which they got to capitalize when during the capitalization phase, so 22 to 24, taxpayers got to keep 100% of their gross credit. Foreign costs, as I mentioned, still needs to be capitalized and amortized over 15 years. And there are some relief provisions for unamortized research and experimentation costs for domestic costs that are incurred between 22 and 24. So taxpayers may deduct the unamortized balance either over 1 year or over 2 years, and that's ratably. So you can't say 10% 1 year, 90% the other year. And certain eligible small businesses may elect to amend their prior year returns to go back to get a refund for the years where they were capitalizing and amortizing in 22 and 23 or 24, depending on what you filed. So effectively, there are 4 choices, right? 1, you continue to amortize in 2024 and you write off the balance in 2025. 2, you accelerate that in 2025, and then 3, you accelerate that in 2025 and 2026 ratably. And then 4 is going back to amend to timely deduct in 2022 or the first year that you're affected, and you will get a refund on some of the taxes that you paid because you had to capitalize and amortize. There are definitely pros and cons to making the amendment if you are an eligible small business. And generally, the eligible small business test is if your average annual gross receipts in your prior 3 tax years are below 31 million and you're not a tax shelter. The election that is to be made in accordance with Treasury guidance, which have not come out yet, which might make your 2024 tax return slightly more complicated because you might say, hey, why are we not doing this in 2024? It's because you have to effectively make the election to amend in 2022 or your first affected tax year. And the way to make that election has not been provided yet. So once that guidance comes out, be sure we will give you guys all the updates there so you can make your decision as to what you would like to do. Big picture wise, though, I'm not going to read through this. You'll get the slides later on, but some things to think about would be around whether or not there's fees associated with amending your prior year returns, right? There's administrative headaches on amending your prior year returns. If you amend your prior year returns, refund from the IRS definitely takes time. And then big picture wise, if you amend to elect to timely deduct your 22 and 23 174 domestic spend, you would actually have to also reduce your R&D tax credit by 21%. So that's a pretty big difference because the 21% is effectively, you kind of get that free money just based on the way that the statute is written right now. And you still get to deduct everything either in 25 or 2026 while keeping your extra 21% of your R&D credits between 22 and 24. So these are all things to kind of think about. And I know a lot of people have questions around this. We don't have a crystal ball as to what it's going to look like in terms of how to make those elections. But again, when guidance comes out, we will provide an update to everybody. And with that said, I'll turn it back to Carolyn on some more 2025 changes that's related to R&D and reporting requirements.
Thank you, Vivian, and thank you for sharing that excellent news. So new Form 6765, it came out in 2024, and it's really a significant change from the Form 6765 that we've been dealing with. Couple things, as Vivian was talking about, the 280C, that's the 21% reduction. So electing either the gross credit or the net credit because of the 174 mandatory capitalization and amortization, most companies did not elect the reduced credit. They took the full gross credit. There was only one unique opportunity where it 280C applied if the credit exceeded the 174, and I did not personally see that. So what's new, right? Section A, the regular credit, it doesn't break out the QREs anymore by QRE type that we discussed. It just has a line for all of the QREs. So interesting, a little misleading because it looks like they're simplifying the form. But can you go to the next slide, please? Yeah, a lot of information, and we do have a snapshot of what the form looks like. So the form looks different, right? At the beginning, you are going to answer whether you're electing the reduced credit, the 280C, or not. You are also going to answer a yes or no question that says, are you part of a control group or part of a group of businesses under common control? And that is very new. It's kind of just a starting point for the increased scrutiny that I believe this new form was created to impact. So it appears simple, right? Because you're just one group of QREs or your QRE total. But as you continue to go through this, it doesn't mean that it's a simplified form. Underlying documentation is mission critical. As you see, as we get further through the changes, there's a lot more information that, including qualitative information, that is really critical. Same payroll offset opportunity for companies with QREs, less than 5 years of QREs and fewer than 5 million in gross receipts. Section C, really no changes. And Section D, the payroll, no changes there. Section E, a lot of new information. We talked about business components before. So now they're asking you to identify the total number of business components. And this is really important. I mean, for years, we've been required to identify QREs by business component, but never to report it on the form on a timely filed return. So it's when you're undertaking a study now, you really need to understand what are your business components. And what they're looking for is no more than 50, which seems significant. I see Marty's note. He's a new dad, and baby's asleep, which is always a win. So no more than 50, and 80% coverage. So if you've got 80% coverage with 75, they do not want you to identify more than 50. And you'll see, I mean, they're asking for quite a bit of information. So number of business components, number of officers or amount of officers' wages that are contributing to QRE. And this is something you need to check year over year. I believe that is, to look for, we talked about direct supervision, high wage executives that may not be qualified. I think it's now just a data point where they can say, oh, is it 300,000? What portion of the QREs are comprised of officers' wages, or is it really significant? Are there any new categories of QREs? So this is an interesting one. The four categories: wages, supplies, contractors, and computer lease costs. So if in the prior year you did not take any computer lease costs, but you are this year, you do need to identify that as a new category of QREs. Are you safe harboring your QREs under the ASC 730 directive? That is, that's important too. Um, so 174, that it makes the ASC 730 directive less, Marty, I see you pop on.
Yeah,
What do you
I
want
just
to
had
know?
a comment. I think one of the most important things about this is that you can't just put numbers on a form anymore. So the IRS is asking you to disclose ahead of time. And basically, if you did a research credit study before, much of that information now goes right into the form and you do it ahead of time. I think they're going to get hit with a number of amended returns this year and almost overloaded with all the capitalization reversals that are going to happen. I view this as an opportunity to put our best foot forward, make the IRS's job easy for them, show them that we have some rigor and some analysis behind what went into the R&D analysis. And it's just an opportunity to claim a credit and help them a little bit. And I think it takes away some audit risk for me as well, as opposed to just putting numbers on a board. It also shows the value of these R&D studies that we do by actually they're becoming utilized and not just sitting on a shelf. So in 2025, the two big drivers are the reversal of this capitalization, which is going to, as I mentioned, cause I think a number of just amended returns hit the IRS, and now more companies wanting to claim R&D and show how much they have and claim the biggest credit, and then allowing us to help them do the work, put it on the form, and then show the IRS what they're entitled to. All of it helps you in the end with audit defense, but I think the more that you put on this form and the more specific you can be, the more prepared you are, and I think the more they may leave you alone. We'll see.
I absolutely agree. I do think this will mitigate and reduce some audit risk. So for 2025, Section G is mandatory. There is an exception if taxpayers have $1.5 million or less in QREs, and 50 million or fewer in gross receipts. They do not have to comply with this additional reporting requirements. And what that includes is, oh, and this is for a timely filed return. If you are amending, you still need to adhere to the CCM requirements. So business component basis, you have to identify your business components, the name. Business component type, is it product, process, technique, formula, or invention? Software type, if it's, is it dual function software or internal use software? And then you also have to identify the information sought to be discovered. So this is a qualitative description. And as Marty mentioned, I do think this can reduce some audit risk if they see, if this is filled out thoroughly and thoughtfully. It's going to be really important. Going to identify technical uncertainties. And then for each business component, you are going to identify the QRE breakdown. So it's a change in the way we approach. There's not the way we approach, but a lot of companies approach R&D. There's no more back of the napkins, just calculations, putting like, I think it's this, or using a trial balance to calculate. You really do need to dig in and document. And then there's also going to be the requirement for control group information. I think Marty mentioned it's an opportunity. It's an opportunity to really be clear about the foundation of your credit claim. And if you're, especially section G in the new form, identifies that, I believe that audit risk is reduced. Now, if it looks kind of perfunctory, there's, your business component is called software development. I also believe that will be, will lead to increased audit scrutiny. All right, next polling question. Are you planning to file amended tax returns to deduct research and experimentation expenditures in the 2022 and 2024 tax years? And that's what Vivian was going into depth about. It is an opportunity. There are some costs, there's pros and cons. And again, we are still waiting for guidance as to how to make that choice.
I think also for everybody here, I think 9 times out of 10, now 7 times out of 10, it's going to be easiest to probably just carry forward that unamortized expenditure and take it all in 25 or 26. You don't have the complexity of going back and amending returns. But I keep running into companies that maybe didn't have the money to pay the IRS in the first place, and they're paying some interest and penalties on underpayments. This will eliminate that by going back. Again, the negative is that you're going to have to wait for a refund sometimes if you're doing the amended side of it, but also in the context of companies that had acquisitions and maybe sold some of the business, that leads to additional analysis in terms of like whether it makes the most sense to go back and amend or take it currently. We're working on all that. And there's just a number of factors that we can get into depending on entity type, depending on like just the generalities of this. There's a lot to it, but I just encourage everybody to take another hard look at whether or not there is any R&D and what you did for it in the past. And as both Carol and Vivian said, there's just a ton of opportunity right now to identify it, quantify it, and take advantage of it and monetize it as best you can. So thank you all for answering the polling question. Thank you, Carolyn. And thank you very much, Vivian and Casey, so far. And now here we go to Glenn, who's going to talk about real and tangible property. Glenn and I have been working together since April 17th of last year. He joined us then. It's been a real add to our practice. And I think now with some of this change in bonus depreciation, this new QPP regime, some of the work he does around 179D, he's just added a ton to us. So Glenn, take it away.
Thanks, Marty. Thank you, everybody. Glenn Lemieux. I'm a director in the Tax Credits and Incentive Advisory Group. So my group focuses mainly on cost segregation, 179D deduction, and the 45L credit. If I get a little animated during this call, it's because not much exciting happens in the world of depreciation. The new tax bill that passed on July 4th is exciting for people that deal with what I deal with. So really quick, depreciation's back, and I will be digging in a little bit more of this later. But prior to the tax bill changing, the initial Tax Cut and Job Act was set to was reducing depreciation every year. It went from 100% in 18 through 22, and it was reducing 80%, 60% in 24, 40 in 25. So it was set to expire in 27. So it's kind of exciting now. Their 100% bonus is back. Now this is retroed back to January 19th. There is a small window of the first of the year through the 19th of January that you may be stuck in the 40% or the 40% bonus window. But yeah, talk to us if that's a situation. So so what this means is that assets that we look at that are 15 years or 20 years or less can qualify for bonus. So what that means is we call those shorter life assets. So anything that we can break out into shorter life assets, 20 years and under, can potentially be fully deducted in the first year. So that's kind of exciting. So it just increases the ROI on cost seg studies, and with 40% and 60% bonus in play, the actual ROI was a bit tougher to explain, but looking forward to working with folks on 100% bonus now. Next slide, please. So more exciting things, the qualified production property. So this was something that was added in the initial House version that was a surprise to most people. Senate really didn't mess with it too much, so it became law. So this is a new asset class. So what it's supposed to do is supposed to generate interest in building new plants or buying and renovating plants for production purposes in the United States. So really what it's doing is saying that if you buy or build a plant, you can potentially deduct 100% of the floor space that goes to a qualifying activity. So what that would mean is if, high level, you're building automotive components, say you're a stamper, the areas of the building that you are actually processing, doing the process related to stamping of the parts could be 100% bonus eligible. Write it off in the first year. Some interesting exclusions to this rule are, most factories have offices space or R&D space or, shipping areas, things like that. So those areas will not qualify. Those will still be a 39-year real property. So we'll have to bifurcate those areas from the total cost of the project. Property held by a lessor. So the times of, if you want to qualify for the QPP, the times of you buying or building a building and then leasing it to a manufacturer, those activities will not qualify for QPP for the lessor. So, and then an odd one, the food and beverage production in the same building as retail sales. I am not sure if somebody angered a brew pub, made somebody mad, but that's kind of what that fits in. If you make food or sell food in the same where make or produce in the same building you sell, it doesn't qualify. So what this starts is on the original use rules are in play. So taxpayer starts, it's January 19th. That's the date for any of the things I'm going to be talking about. And it expires in the 2029. So acquired property. So there's some interesting things with acquired property. So it has to be acquired after the 19th of January date that I mentioned, but it cannot have been used in a qualifying production activity between January 1 and May 12th of 2025. So that's interesting. So I guess what they're trying to not do is to say, I had this plant, I stopped this plant for the last year, now I'm going to restart it. Those properties will not qualify. So, and then it cannot be used by the taxpayer before an acquisition, or it can't be related party. So related party rules are in effect again. So next slide, I'll dig a little bit more into QPP. So like we said, acquired or renovated properties. So I'm going to jump down to the last point. So what is very interesting about this is the written binding contract rules are now in effect. So what that says is that in certain states, and you really got to do your research on this, in certain states, there is laws that says once you have a written or binding contract to acquire a building, that is the date of the acquisition. Doesn't matter when you close. So it's going to be really important for any of your clients, or if you are buying a building that are on the call today, to look at binding contract rules. And it is state specific. So that's kind of an interesting, it's an election. So you do have to make the election on your return. Recapture rules are in place. So you have to hold the facility for at least 10 years in a production activity, or you're going to give back some of that depreciation you took. One of the bigger things that I just want to highlight for anybody here, and especially the tax preparation world, is ADS lives. So that is property that is a not-for-profit, or more importantly, the election, the 163J election is elected. That moves your asset class to ADS lives. That will disqualify you from qualified production property. So it's really important for tax preparers to make sure that you are electing the 163J and you're not disallowing a potentially huge deduction on the QPP side. So exciting stuff, as exciting as it gets for depreciation. So I'll dig in a little bit on the cost seg side for those that don't know what cost seg is or needs a refresher. So cost segregation is really a tax planning tool. So what we're trying to do is increase cash flows and accelerate depreciation for our clients in the first year that the building or property went into service. So it's really a deferral of tax payments. We're giving you deductions. You're going to pay less taxes in the first year, mostly in the first year. With 100% deductions now coming back into play, it's really all in the first year. So basically what we're doing is we're looking at a building. If you did nothing to you bought a warehouse building, if you did nothing to it, you're going to depreciate over 39 years, which is a real property asset. What we're going to do is come in and break that building up into the shorter life assets. So personal property, like in this, like dock equipment, things like that would qualify for 5 or 7 year. And then we'll break out land improvements. So any of the things exterior to the building, parking lots, storm drains, things like that. So any of that stuff under 20 years is eligible for bonus. So, ideally, the time frame is the year you bought or built the building and placed it in service. But the unique thing about depreciation that can be very powerful is that we can look back. We can go back as far as it makes sense. And we don't need to amend a return. We'll do this study in the year that you purchased or put the building in service. So say 2020, you bought a building and you just now decide you want to do a cost seg. We can do the building as if it were 2020, which was 100% bonus back then, and pull all that depreciation into the current year return. And all we do is file a form 3115. There's no amended return. So that can be very powerful. So some of the other benefits at a high level, what we're doing is, while we're in there and looking at the building, looking at what's going on, looking at your GLs to try to make sure we capture all the costs for the study, there's other things we're looking at out there. There's other deductions. We're kind of always looking for other ways to help you. So, and And then there's some other personal property real estate opportunities. And then another one is, our studies break out, buildings into units of property. And that's just inherent in how we do, especially acquisition studies. So it's very useful for, using the tangible property regulations. So that's cost segregation. Here's a quick example. So purchase price, this is excluding land. So if you bought the example I just gave, a warehouse, let's say you bought it for a certain amount, we moved the non-depreciable land out. So really the purchase price should be really the building basis that's available for the study. So what we would do is say, if you did nothing, you're essentially taking that 39 million or $3.9 million property, and you're kind of dividing it over 39, and that's going to be your depreciation expense every year. So, and the reason it's kind of off there is because the first year, if you didn't put it in service in the first month, it gets a little wonky. But essentially, it's you're getting 1/39th of a expense a year. But with cost segregation, you can see that upfront depreciation expense, it goes from 96,000 to 860,000. So that is essentially taking 20% of the total basis available, rough number of 20%, and then applying 100% bonus to it. So you'll see with 100% bonus, it feels like a penalty sometimes because your second year depreciation is lower than what it would be if you hadn't done a cost segregation. And then we can kind of go on, and the first year depreciation difference is really the math there. And then the tax savings. But most people want their refunds and want their deductions in now. You don't want to wait a year. You want to use it now. I want to pay less taxes this year. I can reinvest that money better than the IRS can use my money. So I want those deductions now. So most people think that having that big deduction in the first year using a cost segregation study makes sense. So we can move on. Here's a polling question. Are you planning on acquiring or constructing a new manufacturing facility within the next 2 years?
And I made that a very leading question, Glenn, because I think it plays very much into one of the other biggest things in terms of a new asset class that we can look at.
The QPP.
Yeah.
All
Yeah,
right.
we can think of these as like real estate construction things, but now it's almost a manufacturing like a benefit.
Yeah, it's absolutely a manufacturing play. And while people are doing this, there is more guidance coming. What is a qualified production activity? We're going to get more guidance on that because there's a lot of things that could qualify potentially, but we just want a little guidance before we really start listing some of those activities out. All right. The other part of what my group does works in energy efficient building deductions and credits. So the 179D is the commercial energy efficient commercial building deduction. So we're just going to jump right into what the law that the one big beautiful bill that passed on 4th of July did. It actually it's repealing. It's the law that ceases to exist after the anything that was produced after 6/30. So if it goes in service after June 30 of next year, will not qualify for 179D deduction. So typically buildings, if you start it between now and then you're good. We can still work on a 179D study. It's a square foot deduction. So, bigger the building, bigger the deduction. So really it makes sense to look at your plans. If you're planning on pulling in that deduction, that's part of your stack that you're putting together to make sure it's financially viable. You should consider when the in-service date is, or when the start of construction is. So typically we look at is 5 to 10% of the building budget will be spent gets it and start a production date. So 45L is the residential property tax credit, and that is effectively gone after the same time, June 30 of next year.
And Glenn, I keep interrupting, but one thing we're going to get to when David speaks in a little bit is his concept of begun construction. It's very important for 179D. If we begin construction between now and June 30th, and we place it in service after that, that's okay. We just need to begin construction. I think Dave will talk a little bit about what it means to begin construction. And there has even been an executive order that came out that may affect what those rules, what begun construction means as well. But anyway, just want to.
A lot of TBD going on.
Yeah.
Well, I'll just run through this. So 179D, after the IRA, so after basically January of 23, basically allows a deduction for building owners or designers in the areas of HVAC, interior lighting, or upgrades to building envelopes. So storefronts, insulation, and things like that. So it is a deduction, it's a square foot deduction, and it went from a max of $1.88 in 22 up to a max of 581, which is for this year. So that is a substantial upgrade in the deduction. But I kind of warn you, what they did is they added some requirements, which I'll talk on the next page. So this is available to to designers that work with tax exempt entities. They can actually, or government entities, they can't use the deductions, they can allocate to a designer. So that's can be a really powerful tool. And then one of the new changes was you can actually apply for reclaim a deduction after 4 years after additional upgrades are made. Before, you're one and done. So now that allows facilities that are updating their systems and updating their facades a lot and roofing a lot, that allows a potential deduction there. So you can go on the next page, but one thing that added was the prevailing wage requirements to get that higher deduction. So what that did is it split the deduction into two kind of buckets, additive buckets. So there's a base deduction that is just like it was before. You meet some the qualifying standards of it starts, you're in the money at 25% savings in energy. That savings is based on an ASHRAE standard, and it's a computer model. Basically, we model the building that you are building or renovating, and we compare it to the computer model. And basically, if you do nothing else, you don't pay prevailing wage, you're just doing it just like you did before. It's basically a 58 cents per square foot as a base rate, and it goes up 2 cents every percentage point above 25%, and it maxes at $1.06. After 50% efficiency, you don't get any more. So what the enhanced deduction is if you're meeting prevailing wage or an apprenticeship requirements, that really bumps up to the maximum of 581 deduction. So the deductions are, they reduce taxable income in the current year. For building owners, we can also use the 3115 tool to do look back studies. If you're a designer, you're having to amend return. So this can be beneficial for not-for-profits in that, there's ways that if you're working with a not-for-profit as a designer, you can work with them. Maybe you offer some warranties or extended warranties on things where they'll allow you the deduction. Folks kind of want something if they're giving you something. Sometimes they want something, just in return, a donation or maybe an extended warranty or things like that. So,
Hey, Glenn, we have one question in the chat I wanted to get to. It goes back to PPP, but it's the lessor question that I wanted to address with you. So the question is, how do the PPP rules apply for someone that buys the building and rents the property out to a group that does the manufacturing and the production?
So what they're looking at, and the way we read it, and again, there's guidance coming, what it is that if you are the person leasing the building for qualifying activities, then you are the one that would be eligible for qualified production property. If you built a building or bought a building and built it out and are leasing it to somebody doing those activities, as the building owner, you are not eligible for QPP as we read it now. So I know I have a lot of clients over the years that's all they do is build buildings and they lease them out for somebody to do a qualifying activity in that building. That will not qualify for QPP.
I guess this is truly then for the manufacturer themselves, trying to, I guess, give a benefit to manufacturers, and so that they will bring manufacturing into the U.S. and maybe make it cheaper.
Yes, absolutely. Versus, I think they're really trying to drive the core manufacturing, the core, transformation of products into tangible property. They're not interested in helping people build the real estate, which, you can look at that how you want, but they're really just trying to focus on that transformation of product and who owns that. So, all right, you can move it on to the next page. So like we talked about, so opportunities for designers. I think, I came from a background that we didn't talk a lot about working with designers. Most of what we talked about was building owners, but it can be very powerful for designers to get in 179D allocation. So some of those are, these folks that own the following examples do not pay taxes. So they cannot use a deduction. So if you're, a designer and you had design responsibility for writing specs for dorm rooms, airports, libraries, courthouses, K through 12 schools, additional, what was added in the IRA, which was not there before, was schools, religious institutions, and tribal or Native American owned buildings. So it's a very powerful tool And some of the federal buildings, they require prevailing wage to be paid on their project. So if you're a designer on a federal project, it might be something to look into for the 179D allocation, because you might qualify for that $5.81 a square foot. Next page. Last polling question for me. Did you make any upgrades to the HVAC, interior lighting, or building envelope of a commercial facility within the last 3 years? Or are you planning to within the next year? Not at all a leading question.
If you did or you're gonna, you should talk to us about
Yeah,
179D.
very powerful
That's
tool.
the point here. Yeah.
And what I don't have on there is you put 179D and cost segregation together. If you're a building owner, that can be a very, very powerful tool. So,
Absolutely. That's been sort of the thing that's been powering our studies in as bonus trended down. Now for the next year, I think we're going to have like a lot, like bonus plus 179D. It's great. Okay.
all right. Thank you, everybody. I'll
Thank
hand it
you.
off to David here.
Now we'll move to David Moamani while I wait for this polling question to come up on a yes or no. I think I should have put some NAs in there as we went through this thing. But David, you available?
Yep.
Very good. We're going to talk about energy credits. David joined us a little over 2.5 years ago, I think at this point, almost, right? 2 years ago.
Yeah,
Anyway,
2 years ago. About.
David's been a superstar and continues to be, as the law has both been enhanced and now been changed, and now we're sort of planning for the future and everything else. So David, take it away and talk about what's happened.
Yeah, so as many of you probably know, the Inflation Reduction Act enhanced and extended a lot of these clean energy credits. And what the one big beautiful bill has done is sort of cut some of those short, as well as changing materially kind of how they are effectively used. So the credits that are going to be terminated in the shortest order are 30C and 45W. 45W is for the commercial clean vehicles. That is now terminating on September 30th of 2025. 30C, which is generally utilized when claiming a credit for EV charging stations, that's terminated for property placed in service after 6/30/2026. The two things that really got impacted the most by the one big beautiful bill with respect to these credits are technology specific towards solar and wind, specifically sections 48E and 45Y. Those are now terminated for projects placed in service after 12/31/27, unless construction begins within a year of the bill's enactment. Additionally, there was a complexity added, which are these foreign entity of concern restrictions, which we'll get into on the next slide, please. So the foreign entity of concern restrictions really apply on two levels. There's the taxpayer level, and then there's the project level. So the taxpayer level is if you are this foreign entity of concern. So these are prohibited foreign entities, foreign influence entities. You will no longer be able to claim the credit if you are such an entity that's listed on these foreign entities of concern, or they are your parent company, or they have a certain threshold of ownership within your company or equity. It varies based on kind of what the exact ownership structure is. The more significant impact, because it's not necessarily as easy to tell on its face if this would be triggered by things you're doing, are on the project level, because there's this material assistance restriction now, which essentially, if you are sourcing components for parts of projects from these foreign entities for a project that's claiming a credit, you will now no longer be able to claim that credit because of where you source the materials from. What the material assistance restriction does, and it applies to projects starting January 1st of 2026 on the project level, is you have to run this calculation where you determine what percentage of the total project cost and components were received by these foreign entities of concern and which was not. The percentage phases upward and it varies by technology. So as we move into subsequent years, a greater threshold of the project will need to be sourced by entities outside of these foreign entity of concern. One of the things there that's really important to note is there's going to be a lot of due diligence done when choosing suppliers and where they're getting their components from. Because just because like their warehouse is not in one of these countries that's identified as a foreign entity of concern, if they are under a foreign entity of concern's ownership, they still apply. So there's going to be a lot more diligence in that respect to determining how where you're sourcing these components from, and it's extremely complicated. To be quite honest, the foreign entity of concern restrictions. We're still kind of awaiting some nuances and guidance from the IRS about particular elements of these set of restrictions, but it's important to recognize that this is something that is going to be enacted on the project level starting next year, and it's going to impact projects across the board. And that material assistance calculation is going to need to be done for all projects, and it does change the percentage-wise based on the type of credit you're claiming and also the technology within that type of credit. Now, what's nice about this, at least for now, is we have these beginning of construction rules that allow you to safe harbor and determine and establish that construction has begun on a specific project. So for projects that on the project level that begin construction prior to the start of next year, as it currently stands, they are exempt from these FEOC restrictions. Sorry. There's two general ways that we satisfy beginning of construction for energy credit projects. There is this physical works test, which is demonstrating that physical work of a significant nature has begun. The second element, which is largely the one that people will utilize when documenting that they've met beginning of construction, is this 5% test, where you are documenting that 5% of the total project cost has been incurred. That will deem a project as beginning of construction. The reason this is so important is, one, for the FEOC restrictions and making sure that if you can establish beginning of construction in this year, it's best to do so to kind of avoid that complexity. The other reason that it's so important is specifically for solar and wind. As we move for the projects that are able to satisfy beginning of construction within a year of the bill's enactment, so prior to July 4th of 2026, they do not have the same hard termination date for solar and wind that projects that begin construction after will. So essentially what you can do is begin construction on a project in the next year, or a little less than a year. And if you are able to satisfy those requirements, you don't need to place it in service by 12/31/2027 to generate a credit. You will be exempt from that. You'll have an extended window. Now, there are continuity requirements within that, within these safe harbor provisions that you will have to pay attention to, but it does give you a longer runway to have these projects generate credits for those that can begin construction. After that, if the project begins construction after this initial year, it has to be placed in service by the end of 27 to claim a credit. Go to the next slide, please. So I know we're running out of time here. The one thing that is still uncertain is on, I believe it was July 7th, Trump issued an executive order directing the Treasury to look at the guidance for beginning construction. I think now it's viewed as a little bit too lenient. So they want to make it stricter is kind of the intent of what the executive order was asking for, but we don't necessarily know what that's going to translate as. It could be increasing that cost percentage above 5%. It could be a more thorough documentation of physical works of a significant nature. We just don't know. If we're looking out 45 days, hopefully sometime at the end of August, we should have more insight into whether or what those new changes are and how we have to view them from the project lens, but that's something that's still unknown. And I know I don't want to run over. I think there's one last polling question. Okay. So last polling question, and we really appreciate your time here. Do you want someone from Cherry Bekaert to reach out to you about the topics discussed today?
Yes, no, or maybe in 3 months. Okay, so that concludes this one. This is 2 of 6, I think. And so the next one is called Your Financial Legacy, Key Individual and Estate Tax Shifts. And that's on Wednesday, August 13th. I want to mostly thank Casey Pittman, who all these things revolve around. We say it revolves around the bill, but I really think it revolves around her in many ways. She's been great in terms of like getting these things organized and helping us present all this on the big, beautiful bill. I want to thank everybody for joining. Remember, recordings are available in about a week should you need them. Thank you all for joining, and please reach out to me if you need anything.